can't see me. I'm like, yay. I'm gonna mute myself. Hello. How is everyone? We're going to give everyone a minute or two to come online. This is for the big, beautiful tax bill, so make sure you're in the right space. At least give it till 10:02 to let people show up. So hope everyone is good. I'm going to make sure our variable back end systems are working well. Looks like we're working on the back end side. If you don't know me, I'm Misty Newsome. We're a local CPA firm in the Katy, Richmond, Fulshire, Sugarland area of West Houston. And we're here today to talk about the big, beautiful tax bill. We give everybody just a minute. I see a handful of us are all here. Yay. Let's go ahead and share our little screen here. Okay. I'm going to turn off this part. And hopefully there's no background music anymore. All right, guys. Well, a little housekeeping. Again, my name is Misty. This is our very first time going live and streaming, so just pardon the dust if we mess anything up. We are hoping that you are able to chat and comment, and throughout the presentation, Tonya will be speaking. Feel free to comment. We're going to gather all those questions, and we'll have 15 minutes, maybe a little more at the end, to go over all those questions, okay? So if there's a question, and if you were like, what in the world does this mean? Just ask away, and we're going to get to those all at the end, okay? So now let's get into who we are. So before we dive into the big, beautiful tax bill, just want to quickly introduce our firm, who we are, what we do. So we are an accounting firm. Obviously, you can tell by the name Misty Newsome CPA LLC. That's me. I have been doing taxes since 1999 when I worked at a CPA firm in college at Baylor University. I love tax, payroll, bookkeeping, small business. I love inspiring business owners and coaching them on to the next step in their financial future. But it's not just me. I have a team of 10 that work with me. You will see one today on the screen, and the rest are all in the background, making sure everything's working, including my husband, who doesn't work for me, but who is lovely. And at the end of the day, we hope that you will have a little bit better understanding. I mean, just in the past 4 days, Tonya and I have messaged about, did you hear this part of the bill? No, I didn't hear that. I heard something else. And she dug into that 900-page bill and made sure we have everything for you. I will say this presentation is geared a little bit more towards individuals, but we will hit on some business stuff, and we will maybe put together another webinar solely for business owners in a few weeks. So to introduce me, part of my testimony is I've wanted to be a CPA since I was 10. My uncle was a CPA. He was a banker though. He had banker's hours. I liked all his holidays he had off, and it inspired me at a young age to want to pursue accounting. So yes, you already know I'm a nerd, right? I started this firm in 2021 once COVID hit, and I was working way too much helping people with PPP loans and EIDL and ERC credits. And I realized this could actually be a real business and not just my little side thing I do during tax season. So I started this to work from home. I had been doing that for years. My husband and I have 6 kids that we homeschool, so it's chaos always. And I have been able to grow my team, grow who we're reaching and who we're serving, and it's been a huge blessing in our life. So now I want to introduce our speaker today. Tonya and I found each other about three and a half years ago at a conference. We use the same software. All of our software synced up, every single one of them. So we loved each other. She has been doing taxes for over 20 years as well. Came out of the military, fell in love, and has been doing it ever since. She loves simplifying tax laws. And I'm telling y'all, even me, like, I'm like, I know the gist, tell me this. And then she'll go dig into it and make it simple so that other people can understand it. She has worked in a zillion different industries. I swear, I'm like, how have you been doing taxes for 20 years and have all this other experience? So she's a wealth of knowledge. She loves gardening. She loves taxes. She loves her kids and her family, just like we all do. So the whole point of this webinar is to give y'all unbiased information about what this might look like for you, for your family, and things and processes that you can maybe put into place after knowing the new law. So I'm going to take myself out of this, and I'm going to let Tonya take it away.
Thanks, Misty. So we're going to start today with just kind of a brief rundown on what the big, beautiful bill is. So formally, it's called the Tax Relief for American Families and Workers Act of 2025. Basically, it's to extend the Tax Cuts and Jobs Act permanently. And it was sold to simplify the tax code, expand some middle class relief, and it definitely is focused on reversing a lot of those Inflation Reduction Act Green Deal spending. It was introduced in the House in May as a budget reconciliation bill. Now, we heard a lot of stuff about this, but really what that means is that they can't add anything else. If it does not have a one-to-one direct line item spending bill, if it didn't directly deal with money, it couldn't be in the bill. So this is very different than a budget bill, because in a budget bill, you can put new line items in, you can remove full things. What you can't do in a reconciliation bill is add new stuff, completely cut spending in a lot of different ways. You can move deadlines and those kinds of things, which is what happened in this bill. It passed the House on May 22nd with barely bare minimum. Again, it went to the Senate, passed by the bare minimum, and then went back to the House and again passed by a bare minimum. And then the president signed it into law. So now we have the big, beautiful bill. Now, there's been a lot of online speculation versus what really happened. So we're just going to quickly kind of run down what has been said online versus kind of what really happened. So a lot of online said leading up to this the entire time, right? We're going to make TCJA permanent. There's not going to be any tax on tips or overtime. There's not going to be any tax on Social Security income. There's going to be an auto loan interest deduction. The SALT cap is going to increase, and we're going to require earned income credit to get some certification. Now, what really happened was some of the Tax Cut and Jobs Act was made permanent. We get no tax on tips temporarily, and there's a lot of restrictions around that. And then the same with overtime. It's temporary. There's a lot of restrictions around it. We did not get a no tax on Social Security. What we got was an additional senior deduction. We'll talk about that in full. We also did get a new auto loan interest deduction. We'll talk about how that works, along with we did get a SALT cap increase, very temporary. Again, there's a lot of restrictions around it. And then we did get, there were no changes to the earned income tax credit. So, Misty, thank you. All right, let's get started in kind of the big stuff. There's a lot of information on these slides, and I'm going to go super fast just so that we can kind of get to those questions on the end. Things that stayed the same. Now, if you'll notice, I have one box for this. Everything else got slightly changed. So we're still going to see the same income tax rates that we have seen for the past several years. Our standard deduction is indexed. We did get a larger bump than we were expecting. It'll be $15,750 and then $23,625 for married filing jointly. Our other dependent credit stayed exactly the same. The estate and gift tax exemptions of $15 million stayed the same, and our student loan forgiveness stayed the same. As what this portion really means is that when you get your student loan forgiven due to death or disability, permanent long-term disability, then you don't have to pay forgiveness tax on that. So let's get started with the fun stuff. Go back one. Thank you. Things that are slightly changing. Our child tax credit is now indexed. It has not been indexed previously. What this means is that we're going to get $2,200 per child starting this year, and then it's going to be indexed for inflation. So this number is going to go up. That's kind of nice. And let's talk about our senior deduction. So we've always had a senior deduction. It's an additional deduction given to those over 65 or if they're blind or disabled. That's just kind of how that's always been. It's always been around $1,500. Well, it's currently $2,000 and $1,600, and that's kind of dependent on, are you single? Are you married? Is it your spouse? Is it both of you? It's kind of how it works. Now, the temporary increase is for those making under $75,000 as single or $150,000 as married filing jointly. You'll get up to a $6,000 deduction. And that phases out when you make more income. So it completely phases out at $125,000 and $200,000. We'll take a look at kind of how that breaks out. Misty? So for all of these scenarios, I want you to know that scenario one is how tax law was previously, this year, right, in 2024 taxes. Scenario 2 and 3 is what it looks like now that the bill is passed. So Mary's 67. She's recently widowed, so now she files single. She has an income through retirement, accounts, investments, and Social Security, of which $30,000 is taxable income. Now, this is very common. This is one of an example we have from our firm. This is often. If you have more than $20,000 of other income, your Social Security numbers get taxed. So how does this look? So in scenario one, as of this last year, if you have an AGI of $74,000, you get the standard deduction, you get the additional deduction, and your taxable income is $57,000. Your effective tax rate is a little over 10%. Now, after the bill, same exact numbers, right? So our AGI is exactly the same, 74,000. We're married, or we're filing singly. So we get our standard deduction, the new the new raised standard deduction of $15,750. We get our new additional deduction of $6,000. So that leaves our taxable income of $52,000. So our effective tax rate, it does drop our effective tax rate, a little over 9%. Now, the difference is when we make slightly more. So $90,000, we can all agree, is not too much money. It's a very good living for a lot of people. Standard deduction, $15,750. The additional deduction is only $5,100 at this level. Brings their taxable income down to $69,000, but their effective tax rate is a little over 11%. almost 12%. So what this really looks like is it does help. There's some cravats around that, right? So this additional deduction is only available until 2020 through tax year 2028. So when we file taxes in 2029. And then it's set to revert back to what it was. So just keep that in mind, Misty. All right. The next set of things that are slightly changing. Our AMT still stays up there. We're getting a larger clawback though of 50%. Our mortgage interest deduction still stays at the $750,000 borrowing limit, but it also does add mortgage interest premiums as deductible interest. So that'll help some people. All of those nice PMI numbers. Casualty loss deduction stays the same, but we've also added state declared disaster, so it doesn't necessarily have to be a federal disaster. Itemized deduction limitations. This is the Pease law coming back into effect. It only affects the top end people, so that 37% bracket, and it is a 2% reduction overall. And our qualified business income deduction. Now, our thresholds have increased in this and our phase ins, and it does set a minimum deduction of $400, which will be indexed, and it does set a income limit for being able to take it. And this all of these rules start after this tax year unless specified. So we do have to make $1,000 in the income. So there won't be any more QBI deductions with $2 or $3, or even $100. So the minimum deduction does have to be $400 moving forward. Let's take a look at how that affects things. A little bit more here. We've got moving expenses deduction. The old stuff is gone, you guys. Military only. But it does add the intelligence community, which is a lot of people. So it's all the spies now get to deduct their moving expenses. ABLE accounts. This is a pretty good one. So if you don't know about ABLE accounts, they're really nice, especially with those with children with disabilities. There are indexed contribution limits now. It is not a flat set fee contribution limit. It does qualify now for the Savers credit. So all of our kiddos that are over age who also contribute to an ABLE account can get the Savers credit. And rollovers from our qualified tuition programs continues. So we can roll over from our educational accounts, our 529s, into our ABLE accounts to fund them still. And our Savers credit got a nice bump. So our Savers credit has not had a bump in a long time. It is still not indexed, but at least it got a bump. So it's now $2,100. Our SALT cap deduction. So our SALT cap deduction went from $10,000 to $40,000. So, but our $40,000 is indexed over the next 4 years, but it is income limited to $500,000. Of course, $500,000 also falls into that 37,000 or that 37%, and that means that their itemized overall is also limited. And then a huge section of Africa was added to the Armed Forces Hazardous Duty area. Let's see what that really looks like. All right, so this is for a married filing jointly couple. They live in Texas, so we're not dealing with state taxes. And they have a decent sized house for which they have a mortgage. So we're looking at our interest and our taxes, right? They itemize, they make decent money, and they also give often to charity. So before our bill, they make $320,000. Itemized deduction is $44,000. Taxable income, $275,000, and our effective tax rate was 21.3%. So after our bill, making the exact same amount of money, we're looking at that itemized deduction being $56,000 because we're not capped on that SALT cap, that state tax level. So that brought down our taxable income to $264, and our effective tax rate is a little over 20%. So it saved us 1% of our taxes. Now in scenario 3, we're kind of looking at how this hits overall. We're looking at our cap for our itemized deductions. We're looking at our SALT cap and kind of how that all plays in together. So our couple makes $550,000. They're in that top tax bracket. So they're going to get their reduced itemized deduction, but the reduced itemized deduction is not only limited by their SALT cap, it's also limited by the 2% overall. So that brings their itemized deductions down to $43,120. And so that leaves our taxable income of $506,880 and our effective tax rate of 22%. So there's some good and bad pieces to all of this. Now the fun part, renewals and adjustments. So these are some things that are going to be new and are not new, things that are coming back, things that are adjusting slightly, kind of outside of what was with TCJA. All right, bonus depreciation is back. It is permanent. It's back to 100%. And it's anything put into service after January 19th of this year. R&E expensing for domestic R&E, research and experimental, is fully expensed. Foreign is that 15-year amortization. You'll find a lot of the foreign things in this bill have been pushed out. There's been kind of carved out, looking really focused on domestic interests. Now, small businesses may be able to recapture any of that R&E expense all the way back to 2022 by claiming it on 2025 taxes, or claiming it on 25 and 26 taxes, with an adjustment to your accounting method. Ooh, our business interest limitation. So this is back to our EBITDA calculation, and what that really means is that you get limited on the amount of business interest that you can write off based upon the amount of income that you have. Now, the way that we calculate that income now has gone back to before interest, taxes, depreciation, and amortization. So you get a larger amount. It's kind of looks more like your P&L versus what your tax return looks like. So that'll help some of our business clients. Our Paid Medical Family Medical Leave Act. So this is back. It is an employer credit. Wages paid during FMLA is included in this credit, along with insurance payments, which is the slight tweak to this as well. Our Section 179 expensing now has a higher limit, up to $2.5 million. You can expense up to $2.5 million a year. And our employer provided child care credit. So a lot of people go to their W-2 jobs and they have a cafeteria plan for their dependent care credit. That limit has now been raised. And the flip side of that is the employer also gets to write off a good portion of if they provide child care for their client, for their employees as well, up to 40 or 50% if you're an eligible small business, and that's up to $500,000 or $600,000 credit, and it's indexed going forward. So our adoption credit starts this year. It is refundable up to $5,000, and that will be indexed. So good news for our adoption families. Now, they also recognize Indian tribal governments for special needs designations, and this is big change because typically it was written only as if the states recognized a child for special needs, not from the reservations. So this is a slip into the bill, which is going to help our adoption families as well. Dependent care assistance, the limit has increased to $7,500. So you get to carve out $7,500 a year now on your cafeteria plans. The dependent care credit has now gone from 35% of expenses paid to 50%. So that is nice. And the phase down range is expanded from 40,000 to 75,000. So more people will get to take advantage of more of the write-off. Now that does phase down to 20% still, but the top end is 50%. Employer payments of student loans are now a permanent tax credit. 5250 will now be indexed going forward as well. 529 accounts. 529 accounts are fun, right? We like these for long-term planning, especially for those with our kiddos. So for homeschool kids, for elementary kids and private school, those types of things, we now get a $20,000 limit each year to remove for those elementary school expenses. And we have expanded elementary expenses, tutoring, curriculum, supplies. All of those now qualify, along with, this is fun, our post-secondary credentialing can also be, so all of our testing, our study aids, these are going to be things that are outside of the kind of norm things, right? So like CPAs, we always have our own fees we have to go take, along with study aids to test for to study for our CPA, right? Project management, certified welders, anything that a state agency qualifies for will cover for withdrawals from that 529 account as an education expense now. All right, opportunity zones. This is now permanent, and they made it on a 10-year rolling designation. There is some new reporting requirements. Just be aware of that if you have clients who are working to open up businesses in those opportunity zones to take care of those tax credits. We do have a new markets tax credit that is now permanent, and this is business-wise, right? Looking at research into new markets. And we do have the qualified small business stock gain exclusion. Now, this is that qualified small business stock that for a lot of our C Corps, for closely held, is when we kind of look at what this looks like. You must hold it still for 5 years to get the full exclusion, but you do get a partial exclusion of those gains starting at 3 years now. So here comes the fun things, right? Our 1099s. We have changes to both our 1099Ks and our 1099 NEC thresholds. So our 1099Ks, so anything that all of our sellers, anything who runs through those third-party people, it's back to $20,000. So you won't really have to worry about getting any of those PayPal ones or the Stripe forms at the end of the year. And then that starts this year. And then our 1099 NEC threshold is to $2,000, and it's indexed moving forward. Now that starts next year. This is a kind of cool thing that they slipped in is the section 181. So 181 is a specific write-off for the theater people. It's always been kind of sets, props, those types of things specifically for the theater. They have now expanded that to include TV and film production, along with your traditional theatrical write-offs. And that includes sound producing equipment, light equipment, those types of things. And then we do have the excess business loss limitation, which has now been made permanent. All right, education credits have been slightly tweaked. It does require a Social Security now, Social Security number, and our AOTC, so our American Opportunity Act, does require the EIN of the school. So it used to be a little tip box that asked, did you get one or did you not get one? It is now required to have the EIN of the school in which that tuition and fees was paid to. The advanced premium tax credit has also been adjusted. If you over-receive your advanced premium tax credit, you will owe all of it back. There is no limitation to the amount of that you will have to pay back going forward. They've removed the limitation, so it does not matter what your income is. You will owe back all of that credit if you received it too much in advance. But a fun thing that we got was HSA plans. HSA plans now include all bronze plans on the Affordable Care Act and catastrophic plans. What this means is that it has now opened up HSA plans for so many people, which is a great long-term strategy for tax planning. And it also does really help with medical expenses when it comes down to it. All right, the fun stuff. Got through all the boring stuff. Now, this is all what's new. So these are all the new fun things that we get to look at. All right, we heard so much about no tax on tips. Well, here's the nitty gritty. When it starts 2025 and it runs through tax year 2028, it includes all tip income from an occupation listed on the federal tip list. Now, we don't know what all included on that federal tip list. What I can tell you is that we do know that food service and beauticians are on that federal tip list. We should find out soon. It is an above the line deduction. So it's kind of like your student interest deduction. It's going to be up there, and it's just another write-off on one of those lines that reduces your reported tips. Reported tips. There's a cap of $25,000. Your income limitation begins at $150,000 for single, $300,000 for married filing jointly, and it goes up to there. It goes up to $275,000, $425,000, which you won't be able to reduce after that. It includes reported cash tips, electronic tips, and pool tip distribution. So anything reported on your W-2 or your 1099 or reported by you during tip reportings throughout the year. The requirements are you have to have a Social Security number. You will see this throughout all of the new stuff. And if you are married filing single, you are unable to take this deduction. So what does this really mean? Our maximum impact for this is a $6,000 reduction in taxes. What does that really mean? That $6,000 is across the board, right? It's got everything's got to be perfect. It's all got to be lined up. You got to make $149,999, and you got to be able to deduct $25,000 of those tips in order to get that $6,000 reduction of taxes. So really, what we're going to look at is a true estimate reduction of taxes between $0 and probably $3,000 from this. Most people that we see in these tip situations either don't pay a lot of taxes to begin with, or with a deduction of $25,000, you're going to be right there at that line anyway, right? So we're not going to see a lot of reduction of actual taxes for this. It sounds really good though. There's some notes about this. When we're reducing this income, it can adjust our earned income credit and those types of things. So we want to be very cognizant of taking these deductions. On the business side of things for this, We should be able to, if we work as an independent contractor in one of these fields, we should be able to write off our tips as long as they're reported to us. And they will also be excluded from our QBI deduction. So it can reduce that qualified business income deduction as well. Beauticians are now included in all tip laws, including the federal minimum wage tip law and including the employer FICA tip credit. The secretary is supposed to be releasing a complete list of covered occupations, but we do know that food and beverage service industries and beauticians, because they're codified in law, we know that those two are on the list. And like I said, this does not exempt your tips from being covered for your FICA or your Medicare tax. So it's not covered out of, you're still going to pay your Social Security and you're still going to pay your Medicare taxes on that income. You get it from your federal level. And it is going to impact your eligibility for calculations for earned income credit, child tax credit, dependent care credit, all of those types of things. All right, no tax on overtime. Again, we're limited to 2025 through 2028 tax years. We're going to exclude your overtime compensation from federal income tax. Again, it's another above the line deduction. The cap is $12,500 per individual or $2,500 for married filing jointly. There is an income limitation phase out that starts at $150,000, $300,000 married filing jointly. Now, this is going to affect a lot of people, this income phase out and this cap in general. So the definition of overtime means that it's got to hit the Fair Labor Standards Act, the wages above 40 hours a week or 8 hours a day. It excludes your tips. The requirements are, again, you have to have a Social Security number, married filing singly, unable to take the deduction. Employers have to file them separately on your W-2s and your 1099s. Now, our tips have been filed separately for a while in general on our W-2s, but this will be a new box that we get to file on our W-2s this year. So our maximum impact is a $3,000 or a $6,000 reduction of taxes. Again, you've got to hit that limit, and this is only up to the actual amount of overtime compensation that you received. The real impact, we're probably looking at somewhere between $100 really and probably $6,000 of reduction of taxes, because the people that are really going to be able to benefit from this are going to be those that work retail, kind of those hourly workers at that. The ones that would like to benefit from this are your oil field guys, your trade workers, those kinds of things. Typically, y'all are going to be kind of either income phased out, or you're just going to be capped at what you can really get good benefits off of this from. No tax on new car loan interest. So our tax years 25 through 28, we're really looking to push domestic cars with this. It is another above the line deduction. We're going to get similar to a 1098 for our mortgage interest. We're going to get something similar for our car interest. The cap is $10,000 a year. The phase out begins at $100,000 for single and $200,000 for married filing jointly. And it's phased out pretty quick. So $150,000 and $250,000. So eligibility, it has to be a first lien loan, and it has to be for a new vehicle. And the final assembly has to be in the US, and it has to be under 14,000 pounds. And it cannot be used as a fleet commercial, or it cannot be used as a salvage vehicle. The requirements are you have to report your VIN number on your tax return. And then lenders are going to get us our little nifty form that we have to file. And the maximum impact of this is going to be $2,200 reduction of taxes. Again, this has to do with, are you hitting all of those numbers, right? All right, so our Trump accounts. Now, with our Trump accounts, we don't know a lot about this. This is what I gleaned from the tax law, the way it is written. We will see as this continues to come out, because a lot of the tax law was written around how the pilot works. So there is a pilot starting next year through 2028 for children born this year through 2028. It creates a tax advantage retirement-like accounts for children. The requirements is a child must be under 18. Children and parents both must have valid Social Security numbers. And the contribution details. So there's going to be a one-time federal contribution per eligible child through the pilot program. There's an annual contribution limit of $5,000, which will be indexed after 2027. There's going to be the availability for employer contributions allowed up to $2,500 per year, excluded from employee income, indexed for inflation after 2027. And so there's no method for how that happens right now. That's going to be in some of the guidance that comes out. This is the key part of this. There will be no withdrawals allowed from these accounts until the beneficiary turns 18. So in the calendar year in which the beneficiary turns 18 is the only time you will be able to remove any money from these accounts. So the money in these accounts is stuck until it gets there. So how do we establish these accounts? That's a really good question that we do not have answers to right now. What we do know is that there is a provision in the bill for the secretary to create them based upon within the pilot program. And there's going to be some opt-in. How that's really going to work, we don't know. Or there's also some provisions for them to be created in the U.S. for a minor and funded by a qualified rollover. Don't really know what that looks like yet either. We're going to have to wait for guidance to kind of figure out how these work in general. But it does require that there is a 12-month wait in order to establish and fund these accounts after the date of the enactment. So it may be next year before we get some clarity around what these look like. It does limit how these funds in these accounts are invested. They have to be invested in US only based index funds based on market capitalization. And because this is tied into the retirement section of tax law, that's kind of where they put it. The expectation is that it's going to be treated similarly with withdrawals on the Roth IRA kind of end of things, the way that it's kind of been written. But there will be tons and tons of guidance coming out. So I just want you to make you aware, because this has been there. And we've been made aware of it. So this is just kind of, we don't know a lot of this right now, but this is what we do know. All right, so we have some random new stuff that's going to happen. Qualified production property. This is for manufacturing, pushing manufacturing here in the US. So they get 100% bonus depreciation as long as it's put into service before 2031. State income tax. Oh, sorry, I did not fix this one. State income tax. If you sell there, they cannot charge you if the only thing you're doing is selling into the area. So they're trying to fix some of the differences around having to file an income tax return in every single state if we are just selling there. We don't really have any business outside we don't have any business sitting there. Sorry, if you don't have any economic or not economic nexus, physical nexus, presence nexus inside the state. They're trying to kind of shore up those lines. I'm sure that we will be getting more kind of how that works going forward. We did get the business interest limitation. It's back to the EBITDA. We do have the Paid Family Medical Leave Act. I think I did these already, but maybe not. We get our section 120, section 179 expensing, the higher limit up to 2.5 million. And then we do get a credit for contributions to scholarship granting organizations. This is kind of fun. So if you give to a organization that gives individual scholarships out, you can deduct up to $1,700 separate from everything else. So this is a separate deduction that you're going to get. They have positioned this as a tax credit, which means it's not going to be an itemized deduction. It's not going to be an above the line. It's going to be kind of a one-to-one deduction on the end. Now, these scholarships are designed not for college level. These scholarships are designed for private schools. That is kind of how this law is written. It is directly around giving scholarships to elementary and secondary schools for children to attend outside schools. But the scholarship itself cannot be run by private. It can't be run by the school. So it has to be an outside agency. So they're trying to get more people to be able to kind of fund what that looks like on the outside. But it's kind of a cool little tax credit. Now, some other cool stuff. We get back our non-itemized charitable deduction. $1,000 single, $2,000 for married filing jointly. You do not have to you don't have to itemize for that. But what do we swap for that? Going forward, our itemizers, who are big contributors, right? You can only contribute, you'll only be able to write off 0.5% of your income. So your charitable contributions will have to exceed, so similar to the way that we have that floor on our medical deductions now, that's 7.5%. We have now a new floor for our charitable contributions. It has to be above that 0.5% of your income outside of anything that you take outside of that itemized deduction. So it can't be both. So that should be interesting going forward, kind of how we work that and make sure that everybody's getting the most bang for their buck there. And then for corporations, they did put in a floor and a ceiling. So corporations, in order to write off any charitable contributions, have to hit a 1% floor. And of course, it is still limited by the 10% ceiling for their income for contributions. And then this is a cool little thing that's going to help our farmers out. Section 1062. It's a new section 1062. They're kind of moving other things and putting this in this place. And this is an election to pay in installments, and it does start 2025. So this is only for farmland sold to farmers from farmers. So this is to keep farmland owned by farmers for farming reasons. But what it does is allow the seller of that farmland to really spread out their tax payments over a number of years. So they get to pay their net tax their net gain, the tax on their net gain in installments over the next several years. All right, now what are we losing? All right, so we're losing all the fund credits. So energy efficient home improvement, residential clean energy, all of our clean vehicles, we're losing all of those. So this is our doors, our windows, our insulation, our new ACs, our geothermal vents, heaters, our boilers, all of that stuff, all of that energy efficient stuff, it's gone after this year. Suggest if you're in the opportunity, you thought about doing this, don't put it off. You will not get a credit for it any longer. On the business side, we're losing the work opportunity tax credit and that commercial clean vehicle tax credit. All right, on both sides, we're losing that alternative fuel refueling property credit. What is that? That's that electric charger. If you fall in one of those spaces, you've got until June 30th of next year in order to get them put in. After that, there will be no tax credit. The business side is also losing their energy efficient commercial buildings deduction and their new energy efficient home credit. Now, the home credit is given to builders of energy efficient homes. What does that mean for us as buyers? Well, they typically pass that credit through as some of those credit rebates to home buyers. So if you're looking at getting into a new home that qualifies for that energy efficient stuff, you might want to start looking and talking to those builders now, because you have to be under contract and the house has to be built before June 30th of next year. All right. We're also going to be losing all of our clean electricity production and investment credits. Now, for wind and solar, those end at the end of 2027. And for hydrothermic and geothermic and some of those other clean energies, those facilities lose their credits in 2032. All right. That was a whole lot of information.
Great job, Tonya. Great job. I'm glad it's you and not me. All right. So we want to know if y'all have any questions. I've been kind of looking at YouTube. I haven't seen any. But there might be people that are interested in, like, now that you've kind of heard the information, what do you have? What questions do you have? If you have any, let us know.
Absolutely. I would love to answer any questions. It's going to make tax season very interesting next year. That's for sure.
Yeah.
Things are going to be definitely interesting.
Yeah. I was going to share, just for everyone that's here, this is why we may not be as responsive in the summer. On top of our typical family vacations, we are like constantly taking continuing education, preparing. The IRS likes to wait to the last moment to put out all these things that we need to know about to do tax returns. So many of them come out between Christmas and New Year's sometimes, like the 1099 NEC changes the past 2 years in a row. So just so you have an idea, we seek out like people who are committed to making sure that tax preparers and CPAs and EAs know exactly what's going on, because half the time the IRS doesn't up until the last minute. And then, we have to know and make adjustments at the last moment. So, okay. I don't see any questions. We're going to have to make a push on the next webinar on Thursday night to make sure people are asking us questions. Like if she says something and you don't know what it means, like there was something you said that I'm like, I don't know that people know what that means, and now I can't remember it. So let's make sure we're asking. So we want to give everyone, thank you for the ones. I still see that you're here. You stuck it out. You've been here the full 52 minutes so far. We do have a like bonus for you if you're live. So we are going to look at who showed up and did you stay. We have a tax assessment. If you scan that QR code, you will get the link to see some information about the assessment and book with Haley. Haley's our client onboarding specialist. And you're booking with Haley because we have our management retreat this week, and then Tonya's out of town next week. So, but you have 2 weeks to book a call with Haley. If you're live here today or Thursday night, not watching the replay, and you book, you get $250 off our tax assessment. If you're watching the replay, we still want you to take advantage of this. This is like one of our core offerings for our tax clients. We average anywhere between, I don't know, it depends on the client and their business, but $4,000 to up to $25,000. We saved one client $63,000 last year by putting in. We have over 200 strategies that Tonya obviously knows. I know. We start at the basics and we move up from there, and we get as detailed as you want. So our tax assessment is a big deal. You go meet with Haley 15 or 20 minutes, kind of get to know our firm and how it works. She gets you onboarded. And then the questions start. Do you have a will? When was the last time you met with a financial advisor? What does your business look like? Do you have a succession plan? We go through everything. Tonya gets a big questionnaire from you that takes a minute to fill out. And that's part of making sure we're going the right way with your goals and your objectives for your family. And then you and Tonya sit down for a long meeting to discuss exactly what is important to you. She takes everything from that meeting and then she goes and puts together a strategy, an assessment based on all of your data, your family, your goals. So it's very specified to you and to your family and what you are looking at. And this is something that we suggest doing every year or maybe every other year to make sure that you're really still on track. There's new strategies come out, obviously new tax laws, and to make sure that you're on the front end of it and capturing those deductions as they see fit. There's things that came out in this tax law I wasn't even aware of. Like we just bought a new truck in April. And so I'm like, woohoo, like I might get a little bit of auto loan interest as long as it was, put together in the US. So all those things we have to go piece out, but those are the things we can tell you. Go make sure you get this. Go make sure your loan is going to issue that 1099, 1098. Go make sure that your college that your child goes to is recording the things, right? Making sure that we are getting all and maxing out all those deductions. So if you're still here, scan that QR code. You will also get an email to you in a couple hours. We built out some automation. So again, like I said, this is our first time to do everything. So we're very excited that this worked. It was live on YouTube. We might not have gotten any questions, but it's a big win in our book. We are doing one more of these from our manager retreat on Thursday night at 6 p.m. So if you're watching this on replay, you're probably not going to want to watch this again, but share this with your neighbors, share this with your friends. We've, pulled through all the data, the things that we think will really make a difference in your lives and what that might look like. And I think Tonya did a fabulous job. And I want to make sure that everyone feels like that you can ask this question. So for our current clients, if you haven't booked a tax assessment, do it. If you have a question, send it in the portal. Our portal is being monitored 24/7, even when we're on vacation, even when we have our manager retreat. We have people in there making sure that you feel heard and seen and get your questions answered. So on that note, do you have anything else, Tonya?
I don't. This was fun. I am one of those nerds that has really enjoyed the last 5 days and digging into this law and getting to read it and interpret it and do all the fun things. So this is fun for me.
Yeah. We also, obviously, if you're watching this, it might be on our little webinar page, but it is housed by YouTube. So if you don't know, we have a fun YouTube channel, fun if you're an accountant, but we try to put things out there that make your lives easier so you don't have to keep asking questions. You can go learn and grow. And we have a ton planned over the next 3 months. So make sure you like and subscribe. We're not YouTubers, we're not influencers, but we would appreciate it. And above all else, know that, we live here in Texas. We know what's going on in the Hill Country. We are praying. We are, sending supplies and being as open and honest as we can to what's going on in our world. We want to just share that truth and honesty with you when it comes to the tax side. We can't fix everything, but everyone can do something. So everyone have a great rest of your day. Enjoy your Tuesday. Is it just Tuesday? And we'll see you soon. Thanks, guys.
Thanks, everyone.